is Robert Welzel, and I'm happy that we are here starting, let's say, a panel, high caliber panel with Wendy Walker from Sovos and with Roger Brown from Chainalysis, which will, let's say, introduce themselves. The overall topic of this conference is taxation in times of crisis, but the topic we are discussing here today is, let's say, tax tech, what's going on. So really, we are talking here about the future of the taxation, the future of, let's say, new asset classes, new investment opportunities, new business models will change significantly, let's say, the way in the future we may conduct business. And with more or less 3 trillion assets under management or valuation of cryptocurrencies, NFTs, etc., of course, the tax authorities are first struggling how to, let's say, tax these new developments, how to prepare themselves. Some jurisdictions are, let's say, really introduced a concept how to tackle this. We just received this week the CARF regulation. So it will be a broad topic. The assets, how the taxation of these assets may look like, how the financial authorities in various jurisdictions are ramping up, what are the new business models, where the investors are significantly struggling to declare their tax returns. And I'm more than happy, let's say here, that my co-panelists, which will really drive this panel, I think, because they are from the US, which is quite ahead of Europe in many topics, even if, let's say, from a regulatory perspective and sometimes from a tax technical perspective, Europe is good in regulatory, but let's say the innovation is a little bit more on the US side. So if you, Wendy, starting with you, would first introduce yourself.
Thank you, Robert. My name is Wendy Walker. I'm a solution principal at Sovos. Sovos is a tax technology company. We're the one of the largest private filers of information returns to the United States Internal Revenue Service. I have over 18 years of experience in this area of withholding and reporting tax. I have a background in global financial institutions where I led tax operations and tax compliance teams, reporting not only to the US IRS, but also for information reporting for 1099 purposes, but also for FATCA and the Common Reporting Standards. So I've been sort of working in this area of digital asset tax for the last 5 years or so, following issues, following the evolution of the US IRS regulations around this, as well as kind of their preparation for the coming regulations here in the US. Roger, I'll turn it over to you to introduce yourself.
Hi, good morning, good afternoon. I'm an international tax attorney. I've been one for about 30 years. Say that, I sometimes wonder why I still have hair. In any event, about 10 years with the National Office of the IRS, more than a decade and a half, and partner in different law and accounting firms. I'm head of tax for Chainalysis. We're a blockchain data and forensics company. We serve large exchanges, governments around the world in different capacities, doing and licensing our data and our technology to them to fulfill, what we believe to be a laudable goal, which is building trust in blockchain and the promise for what it represents as a new way to conduct business, record transactions, et cetera.
Myself, Robert Welzel. I'm a tax partner with WTS in Germany, Frankfurt. I'm also more or less 30 years in the tax business up to a certain degree. And within compliance for the last 15 to 20 years on a broad scale of tax compliance issues, operational tax issues for financial institutions and other financial intermediaries. And we started here to evaluate the opportunities of DLT, blockchain, early 2017 and started or established sort of a minimum viable products for for tax in the investment fund arena, and are waiting that, let's say, digital assets of the future really will increase the need for tax compliance. And just by incident, last year the German tax legislator introduced crypto funds as eligible assets, both from or especially from a regulatory perspective. And so, let's say, crypto fund units in Germany is a little bit ahead of the curve, probably in this respect, and therefore many new questions how the, let's say, cryptocurrencies will be taxed and or are taxed, and how new digital asset classes will be taxed. That is more or less my interest at this point in time, and working on some of very early stage solutions. So how to bring this forward? I think Roger and Wendy, you are much better, let's say, prepared and equipped from your business background, really to address, let's say, the intrigue taxation questions. Everyone has to address the tax issues. Everyone has to, let's say, cope with, especially from my perspective, it seems that the US has already a very detailed and system how to tax, let's say, these new asset classes. What you can describe to the present to the audience here.
So I could jump in. So I would say that I don't know that I think that the U.S. I said this to you earlier. I don't know that we're as ahead as you think we are, Robert. I think there's, for some, especially for businesses here in the U.S. that are required to report information to the IRS related to any business transactions that they're involved in, for the most part. I think there's definitely been confusion about, what to report, when to report, how to report things. I think for individual taxpayers, the IRS has done a good job of, sort of explaining that tax is treated as property for tax purpose, or I'm sorry, digital asset transactions are treated as property for tax purposes. And then generally they've provided, I think, pretty robust FAQs to explain different types of products and how a taxpayer should include that on their income tax return. But here in the United States, there is also a system of third-party reporting. And so you mentioned the CARF earlier. The CRS is a system of third-party reporting. But here in the United States, there is a system where businesses are required to report over 30 different types of information returns to the IRS as a third party related to their business transactions. It might be payments they make to employees. It might be payments they make to other businesses, to government agencies. Any of these payments and transactions, many of them are reportable on some sort of information return. And so as such, of course, the IRS has pretty elaborate technical systems in place to receive and ingest all of those different returns from not only individual businesses, but from big companies like Sovos that file large amounts of information returns. And so I think, from my perspective, when you think about some of the key issues that are affecting the digital reporting of digital assets for tax purposes, I think that the US systems, the IRS systems, and how we process that information is something that we here at Sovos have been following very closely for the last few years. So one of the things I wanted to start off by talking about, and I'll kind of lead a little bit into the digital asset reporting that we're expecting here soon from the IRS. The IRS has been modernizing their systems for the last 3 years. Actually, they received funding back in 2019 to start modernizing their technical systems for receiving all of those returns from those different businesses. And it isn't just for the returns. As a matter of fact, they're improving systems like core technologies that you might use to submit information to them, authentication of who you are, and making sure that people who use those systems, are using them for the right reasons. They aren't, that there isn't fraudulent returns being filed and so forth. So much of the investment that the IRS has been doing these last few years has been around those core technologies. But one of the major things that they've done out of that funding is that they have built a new system for receiving those information returns. And that new system is coming. It's launching in January of 2023. And it's going to support just some of those 30 different returns that I keep mentioning. So when you think about those key issues that are affecting the modernization of systems, the IRS told us earlier this year that they're going to release a new 1099 form for businesses to report digital asset transactions. It's going to be called the Form 1099-DA for digital assets. And they are going to, this Form 1099-DA will be implemented on this new IRS information return filing system, rather than, this old platform that they were using in the past. One of the bigger issues that I see with this is that this new system is only going to support some of the 1099 returns. It's very limited in its scope in terms of how, the first year of launching this system, it's very limited in the way that a business can use it. The IRS told the industry they're expecting some 9 billion Form 1099 DAs to be filed in that very first year of reporting, which is supposed to be in early 2024. And so the question is, will that system be ready, to receive those billions of forms? And I mention all of that because I know that there was recently, in fact, we were talking yesterday with Robert, that there was an article where I think in some of the European countries, there's been perhaps a directive to start researching blockchain technology. How could blockchain technology be used to better administer tax, tax requirements and help prevent tax evasion? So that's just some thoughts from like the technical side that I wanted to bring up. Roger, I would ask you, what are your thoughts about that new 1099 DA? What's the practical effect of that form, do you think, for U.S. taxpayers or businesses that have to report it?
Well, it's, I think it raises a host of different issues. Number one, there's been a debate between, this notion of privacy and a notion of how much information should the IRS or the government have about people's trading activity. And there's been litigation in the past about people, the government getting information about salary, bank income, et cetera, on privacy grounds. And in all instances, the government has won. And that's why we have more than 30 forms that Wendy just mentioned, point one. Point two, we're talking about this now because based on statistics the government has put out, and there was a government accounting office report a couple of years ago that basically said 900 tax returns reflecting crypto were sent to the IRS between 2013, 2015, reflecting crypto, 900. Well, you think, how big was crypto? One of the large US exchanges had more than 2 million customers, just that one. So that means compliance was less than 1%. Robert began talking about lack of guidance. We don't need new law to tell us if we buy an asset for 10, sell it for 100, you have gain and you have to report it. That's not new. If you sell an iPhone for that, if you sell a bar of gold for the profit, you sell crypto for profit, there's nothing new about that. So the query came from how the information reporting rules work, because in the same report, the government said that when there's no third-party information reporting, then the level of compliance takes a deep dive off a cliff. It goes way down. So, and then, I don't think it's really driven or motivated by tax avoidance. I think people have a history in a sort of a practice of relying on forms. They get the form from their brokerage account, their bank, et cetera. They attach to their return, they give it to their accountant, they upload it in their accounting software, and they're done. And that's just sort of a matter of course. Where it doesn't occur, people tended not to go the extra mile to compute their taxable income in an affirmative way, and often do something forensic with regard to that, given people's trading on multiple platforms. So you have that notion, and now the IRS and Congress, because IRS is putting out these forms based on Congress's direction, quite frankly, part of the Infrastructure Act that came in, and we'll have these forms as such. I think there'll be different impact on different people. For example, if I'm trading only on one platform and that platform knows my cost basis, my sales proceeds, they can issue me a 1099. And in fact, some exchanges did do 1099s, 1099Bs, which would full, reporting of net gains on transactions where you didn't move your crypto on and off the platform, because they have all of the inputs to know the taxable income components. Point one. Point two, for the next category of people, DeFi participants, or people who self-custody, or people who use foreign exchanges. So what the Infrastructure Act has and we haven't seen the text of the 1099-DA, but presumably it's going to have, and if you think about what we see in CARF, the Crypto Asset Framework, which I think it was very thoughtfully crafted, it's basically report what you know. If you know the acquisitions, report them. If you know dispositions, report them. If somebody transferred crypto off the platform and you don't know, don't report it as disposition. Don't report it as acquisition. Just report it as a transfer. And that's the framework I would anticipate, which is a very thoughtful one and the right one, not to put any coins on a scale of whether something's taxable or not. Just report what you know. Because if it's on your platform, someone acquired it, you know the basis. If someone disposed of it, you know the proceeds. If there's crypto for crypto swaps, it's really two transactions, which the Crypto Asset Framework makes very clear. It's both a disposition and an acquisition, and we'll translate that to fiat currency and report those. And I think you'll also have to report the fee component, because typically you're paying fees in crypto, which is a disposition as well. So you'll have that. And I think from the 1099-DA, it's literally going to put more pressure on people to have to comply, because now the government is getting a form. And when they now do in their own computer systems of what Wendy Walker's trading activity is, they're not going to be able to reconcile. Because right now they get a nice 1099, they say this is Wendy Walker's trading activity, this is her net gain. And if Wendy doesn't put that on her tax return, she gets a friendly CP2000 notice saying, Miss Walker, there's an issue with your compliance. The information we have don't match with what you put on your return. So the 1099-DA is going to have effectively holes. We'll point them out in the government system, because the government's not going to have, CARF is going to take some time, and certain decentralized exchanges will be out, certain Web3 activities will be out. So for many people who are moderate to advanced traders, including those who self-custody, that information will not be there. There is in the Infrastructure Act requirements to do reporting, and as a result of that, reporting for transfers to basically your private wallets. We'll see. Already the industry has started lobbying about not wanting to give private wallet activity on privacy grounds. That'll be an interesting debate because if without private wallets information and without the ability to analyze the activity, can the government effectively assess what people are doing with regard to their own audit activities? So that will be a debate. And it's already happened. It happened in the OECD forums. They were considering this because the original version of CARF had wallet address information. The current one does not. That debate may come out now. And wallet address information, does give a window into the economic activity of the wallet owner, but it also necessarily enables the government to assess whether someone is adequately reporting their activity. So there is pressure there. I would also say that, we will see, I would imagine when the regs come out, a window into who is a broker. Broker is the gateway into who has to do this reporting. There is no mass carve out for decentralized exchanges in the crypto asset framework. There's a pure software providers, pure software companies are out in CARF. Pure message board or bulletin boards are out in crypto asset framework. But if you have more oversight over the way people interact and a greater interest, similar to what you see in the FATF guidelines, then those will be it. So there's no universal carve out. You'll have to look at the particular platform and trading venue where if you're a marketplace, whether you're a counterparty or you're affecting peer-to-peer, you have to ask yourself whether you're in. So all those are real issues there. And then you'll have to also think about cleaning up past compliance practices. So let's suppose I didn't comply in 2018 or 19, but now all of a sudden I find religion, but I still have holdings. Well, what accounting method did I apply? And do I have to go back and clean up past issues in order to come up and deal with these now? The government does believe that not everybody's been checking the box yes on a U.S. tax return, which requires crypto. There's a number of tax forms around the world where governments are doing very similar things. So there'll be issues around there. So I'll stop going on and turn it back to you, Wendy or Robert, if you have any comments on that.
I think that's very fascinating here, what's taking place. And put it this way, in Germany, let's say regulated exchanges, of course, they comply with the rulings and investor information, etc. But of course, many of the investors are investing worldwide, where, let's say, the German legislator, the German fiscal authorities have no clue what is really going on. So they are relying just on the, let's say, investors as such. And as you addressed it already, there's might be a notion not to declare too openly. At least in Germany, we have now some clarification that, let's say, more than 1 year holding of cryptocurrencies, it is tax-free. But if you're really trading, let's say 1 year holding is probably too long, and or let's say within the time frame of 1 year, you have to, it is fully taxable, and even if you do not just exchange, let's say, cryptocurrency against cryptocurrency or whatever, that is a realization event for tax purposes. That is sometimes different in other European jurisdictions. And so therefore, Germany, let's say, and this is what I think very, very interesting right now, we have not established, let's say, the very let's say detailed, let's say electronic filing in this for private investors in this arena yet, and therefore Germany and other jurisdictions, I think, are following a little bit, let's say, the model of the ultimate of or the leadership, or at least has been somehow invented by the US, QI, FATCA, CRS. And now even CARF, where we now really will employ, and you outlined it here, Roger, very transaction, let's say, following every transaction. And with CARF, let's say, Germany and other jurisdictions, they will build up a complete, a very, very transparent reporting regime on a worldwide basis, and at a later point in time, they will establish, let's say, the infrastructure environment really to gather all this information. Currently, it is more or less based on the existing filing structures for the, I would put it, the old economy. So first, they are building up the legal infrastructure. Second, they will advance, let's say, the also the technical infrastructure, but there they are, let's say, at least in Germany, a little bit behind. And ultimately, via this transparency, the reporting will take place, and the tax authorities can, let's say, address the non-filings in a few years' time, and then address the investors. You haven't declared it. So that is currently, let's say, a very issue with the few years ago implemented CRS reporting, that now the tax authorities are addressing the investors. Hello, we are missing some points on your tax filing. Please look at it. And I think this will be the same, let's say, development via this ramping up of the legal infrastructure, and then of the technical infrastructure with the crypto assets, digital assets, especially for private investors in the next years.
You know, I think it's interesting that you both raised the transaction level reporting. So just to give everybody a background on this, in the United States, traditional securities, commodities, we report the transaction level detail to the US IRS. So an information return, a 1099-B, is generally issued for every single trade, for example, of stocks or bonds or other assets. And so on each of those returns includes the cost basis, so that gains and losses can be appropriately calculated for the taxpayer. And within the CRS, within the existing CRS today, we don't report that way. We report gross amounts of transactions to the governments, right? I know that at least for 2 years now, the OECD has been working, if not longer, to establish the CARF. And I remember in the initial conversations with the member countries, the governments were proposing that the industry report every single transaction, similar to what the US IRS requires on that 1099-B. So every transaction for every user. So for example, to put that in perspective, I personally had 3,000 transactions last year in 2021. So that would have meant for me in the United States, 3,000 individual 1099-B forms would have been issued to me. So of course, the industry really pushed back on this during, the initial conversations with the member countries. I think that what we see in the CARF now is a compromise, right? The OECD created an aggregated level of reporting that is, but it is broken down by transactions, right? So exchanges by relevant crypto assets and fiat currencies, exchanges by one or more forms of crypto assets, transfers of crypto assets. So you're kind of bucketing up these transactions and then reporting them out on an aggregated basis, and you show all inbound and outbound transactions in the reporting. So, while not all 3,000 of my transactions would have gotten a separate report or would under the CARF, instead there would be a lot of details on one report breaking down my 3,000 transactions into those buckets, right? I do think that's going to be difficult. I hear, Roger, what you're saying. This is information they have. There's no question to that. But I think about this as an operations person. To construct and then to maintain this will be a bit difficult. It will be difficult, right? The format of reporting as an individual taxpayer, that's not what my tax preparer wants to see. They don't want to see that CARF format. They need to see a different download of all of my transactions that they will probably consume into some software as a CPA, that they'll use to prepare my return. And I think that when a third party has to create another download of information or another layout of that information, the two of those things need to reconcile in some way, right? Whatever they give me as a taxpayer needs to somehow reconcile to whatever they're going to give to the government. And so I just think that is a difficult thing, not only for a company to build, a business to build, but also to maintain longer term in terms of that.
So I like that. I like that comment a lot, Wendy. But it makes me think of the following. We're not just talking here about a country system. We're talking about 100+ country systems, and we are in more than 80 countries. So I actually deal with a lot of these countries, and the reason they do and distinguish between, say, crypto for crypto trades and report them as such, and crypto for fiat trades and report them as such, is because France, for example, doesn't tax crypto for crypto trades. So if I swap ETH for XRP, that's not a taxable event in France. It is in the United States. It is in Germany if it's a short-term holding period. It is in the UK, but it's not in other instances. Next point. The Netherlands has a box system, which means if you're just a regular retail trader, we're not going to tax you on income at all. So, but if you are a really active person, really almost a quasi-professionalist, what you do, then we're going to turn off that box system and put you in box 1. So it's a different box. So we're not going to tax you on your wealth, which is box 3 on that. We're going to put you in box 1. So now it's number of transfers is relevant because people do trade 100,000 times. And that may be indicative of a really active trader. And other countries like the UK or Canada, et cetera, also have these metrics that turn you into a different level of tax given your level of activity. So I think that a lot of that compromise came from having to deal with the reporting in, say, a exchange in Germany. It's not just reporting on Germans. CARF is not about that. You're actually reporting on the Americans, the Swiss, the French, the Chinese, the Australians who are trading on the German exchange. And the German exchange effectively is going to present the raw ingredients so that each country can apply its rules to that. That's the first point. The second point is that there's, 30+ tax calculation software companies out there now. And when, all of us who've been in crypto for a while and we do our taxes, we don't get 1099s typically. A few started issuing them, but they're not meaningful. So as a result, you use a third-party software program, and you either download a CSV file, you get a read-only API key, and you get the data in. That system is now just going to have to be that much more accurate, that much more robust. Some countries, like there's a company in France that only serves France, because their products align to the local rules. Other countries purport to serve many countries. Other companies purport to serve many countries. And the query is they can to a certain degree, but a lot of times they don't, because all they do is they'll serve the accounting method like FIFO or average cost basis, but they won't do anything else. And that's a question and a problem. And what governments also see is that these tax calculation companies produce different answers. And, because they're a calculator effectively, how do you know what logic is going on inside? And why do these companies, all with presumably smart people, all with competent people, all getting professional advice, why do they come out with different answers? I literally had a colleague ask me that her significant other was trading crypto, very active, used 5 different products, got 5 different answers, and asked me which one should I use. And because she was principled and her husband was principled, they took the advice I said, as opposed to just using the lowest one? And how do you know that the tax authority is using that same one? And are you going to get into those level of disputes? I would say, fortunately, I haven't seen governments getting into dueling calculator discussions. They're more so at the level now of the audits of put something on the return, take reasonable positions, and we'll leave you alone. Those are the kind of audits we've seen. Not so much fights on technical issues. There is one in the U.S. court, but it was actually in a court called Jared around taxation of staking rewards. But that was a fight that the taxpayer picked, not that the government picked. That's resolved. Government just wanted to settle, not to fight it. It wasn't worth it, to be honest. That's just, I don't know their logic. It's not big public, but the government just issued a $3,000 check and said, leave me alone. Those technical issues exist, but I haven't seen of the many technical issues that can exist. I think right now most governments are at just put a number on a return that's reasonable, and we won't fight about it. At least that's, again, the informal view that I see from third party. There's nothing that I've seen. There's nothing that I've heard directly from any government, but that's what the public trend you see. Any thoughts on that?
That's the topic here. It's a question, let's say we have just talked about what is, let's say, the intention of the various jurisdictions, and you clearly outlined, okay, as much as transparency as possible due to the fact that there are many, let's say, different tax rules, and let's say probably we will talk in a minute that the taxation of crypto assets is more than unclear in certain circumstances. But on the other side, it will create significant topics, business opportunities, and obstacles for the service, let's say, service providers, such as tax professionals or software companies or whoever will pick up, let's say, here tax and regulatory compliance. You have a very international, let's say, asset class, assets. You have very international, let's say, client bases, which are conducting their trades over the world. It's not, let's say, any longer limited to very specific, let's say, financial hubs. And if you want to be successful, you have to be able to comply with very, very different tax rules. So you need the you need the sufficient granularity to be enabled then to, let's say, comply with each jurisdiction or for the specific needs of your investors. And how this could be, let's say, it's like a big cloud where all the data is in, and then you pick it and slice and dice it for the various jurisdictions. I think that is for service providers a very interesting idea, or of course it's not new, but very, very complicated. And what you addressed, just one remark here for the German tax authorities. On the conference, they said, okay, they evaluated these tax calculation, let's say, for crypto trading, let's say the software, etc. And they analyzed the results are very, very different. And so they are now evaluating what is the background, what is, let's say, what has, how the algorithm of these, let's say, tax calculations have been established, and if it's wrong or right, or yes or no, and what are the issues in the future, because just outsourcing, let's say, that probably might and even the end investor who would just probably use these tax calculations and up to a certain degree will rely on it, but this might not suffice the interests of the various jurisdictions, whether they get, let's say, the returns they are looking for. Yeah? Sorry, Wendy.
Yeah. I would tell you, I think a helpful development would be where tax calculation companies have on their webpage a detailed explanation of their calculation logic. I can tell you that when I dug into some of them, they do some things that in different markets that I know are wrong. And it's, you know, it's just because either I put in my own data, a colleague has put in their data, I talk to the engineer and I say, how do you justify that position? Because it's not allowed in US law, which I'm most familiar with, or country X law that I've studied and, engaged with for purposes of serving a government or helping someone else. And it's not visible, similar to how none of us know the calculation logic and any of the calculators on our phone or on our desks. We just don't know. We just assume it's right. That's not what we're talking about. So there are going to be those things. But, Wendy, I'll turn it back to you because you probably have some thoughts on this.
I was just going to add that I thought it was an interesting topic because I know the US IRS is using those third-party softwares to validate, at least in audit circumstances currently. So there are, and I obviously am not privy to the background check that they've done to ensure that the calculations are correct. But I do recall that it was a pretty thorough process when they, Roger, if you recall, when they put a notice out requesting third parties to submit to participate in that project with them, and then they ultimately selected maybe one or two that they're using. I know earlier this summer when I met with the IRS and talked about this Form 1099-DA that they're going to be releasing, I asked them, to your point earlier, what happens if I, as a taxpayer, receive one of these 1099-DA forms and it doesn't have basis information that I need to calculate my gain or loss? How can I, and so I go and pull my information and I put it together as best as I think is accurate. How is the IRS going to verify that if it's not on my 1099-DA form? And the IRS confirmed that they will continue to use those third-party tools to validate that claims on these taxpayer returns are accurate. And so essentially, just for everybody who may not understand what we're mentioning here, these third-party systems, many of them are purportedly going out and looking at activity across multiple blockchains, so that if I am transferring from one to another, if I transfer from Binance to Coinbase, for example, it's all evident on the blockchain, but Binance doesn't or Coinbase doesn't necessarily know that I had it on Binance originally. There's that transfer of activity that then impacts sell prices and the basis of the asset for tax purposes. Those are the things that the IRS is wanting to validate and that they can use these third-party software for if the software is working appropriately. And so I think, to Roger's point, my 3,000 transactions that we talked about earlier, I tried to use 3 different softwares out there in the market to prepare my income taxes in the US this year. And I didn't get the same result for any of them. And so I ended up doing everything manually. And that took me a very long time. But to your point, Roger, I took a position. I stuck with that position. It was a lot of detail and a lot of work. And the IRS said, okay, and checked it. And I moved forward in the process and I didn't get audited. But you see that, these systems are, at least until some sort of third-party regime can really be relied upon, those systems right now are a little scary to me that the IRS is using them, because, to your point, I don't think that they've really been vetted well. And Robert, you just said that the German authorities found incorrect results in some of those. I worry about taxpayers that are relying on those, or CPAs that are using those to prepare returns, because they're not being vetted.
There are 2 questions that we can take a break and answer real quick. So I'm from Slovenia, Europe, and I have several wallets, and I'm registered on several trading platforms as well. And so far, I haven't used any of them. I didn't do any trading or purchases on platforms or wallets, so I understand. I don't need to do any reports, etc. So 2 points. Number one is that if you're just holding an asset, then you're not buying or selling. Not aware of any country that treats it as a taxable event, point 1. Point 2, some countries have a wealth tax. For certain provinces of Spain have a wealth tax. The Netherlands has a wealth tax. Different Arabic countries also. I don't know if Slovenia does. So if Slovenia has a wealth tax, your wallets would need to be reported in whatever wealth tax. Most countries don't have wealth taxes, but certainly some do, as I mentioned to several that I'm familiar with. Next, how can we identify customer transactions that originated from cryptocurrencies, and how can we report them in relation to FAQ and CRS? So with regard to CARF, they actually say that with regard to transfers out, that a crypto asset service provider is reporting, if you know that they came from things like airdrops and forks and staking, you're supposed to report them as such, that the person received an airdrop and therefore they're transferring them out. So that's an instance of the aggregate reporting and detailed reporting that Wendy was talking about a little earlier, that's now allowing a country to say, hey, what is my rule on airdrops? And I think a very interesting one that Australia put out recently was that Australia is going to differentiate between airdrops of tokens for which there's an actively traded market and tokens that are not. So let's take the Bitcoin Cash, for example. When Bitcoin Cash, the Bitcoin fork to Bitcoin Cash, and Bitcoin Cash was airdropped, it was actively traded. You can get a price for it. Certain exchanges didn't grant immediate access, and countries like the United States have issued guidance, it's informal guidance, where we're not going to tax you until you get access to your tokens. So it's a timing issue. Before that is the time of the airdrop, and people said, well, I was on Coinbase and I couldn't get my tokens. So, and they didn't, for 4 or 5 months, didn't grant access to it, didn't support it. If you look at all the transaction, all the exchange docs, they're not telling you that they're going to support every single token that gets airdropped. So, and they don't have to. So therefore they didn't. IRS issued a formal guidance saying, okay, it won't be until December of that particular year, because the airdrop happened in August of 2017, and Coinbase didn't allow, I think, till December of 2017. And the IRS said, okay, that's okay. Lots of people get airdropped all kinds of tokens, I'll call them shit coins because that's the term of art, that don't have an active market. Whether or not they actually will have value, who knows? Don't put me in a forensic exercise to have to determine the value of this where I can't get it. And the Australian approach was very sensible to say, don't declare it. It'll be income to you when you sell the token. And then we know what income it is because somebody gave you something that's presumably a marketable asset for that. So that was very sensible. Different countries actually have taken on different kinds of guidance. The UK took on DeFi. One of the few that has, with regard to I lend you my token and people were trading against it. That was, I thought, a very courageous move by the UK. Many countries have not taken those kinds of things on. I think it's because many regulators, before they really understand things, want to study it, and it takes time. And crypto is moving a lot faster, and DeFi really grew fast in the last, say 2-ish years. And that would be a very quick time for the government to address something that's not abusive. Trading crypto is not abusive. They're just lack of guidance. And I would say that, many people with some degree of experience in tax can get an answer to the vast majority of trading activity, either a range of reasonableness. May not be taxable now, but it's taxable later. But it's one of those. It's not going to be never taxable. So that's where I think you're going to get in trouble for many different some positions that people take. And I think that as a result of, yes, people with experience and people on this call have experience, but crypto is largely retail. And they don't have decades of experience that people have. So to get advice on some of these issues can cost tens of thousands of dollars. And a retail investor is not going to do that. They're going to go on crypto Twitter and they're going to see something as somebody posted and you don't know their background. And I've seen some of the advice people ask me, and it's like, no. Somebody said I can trigger a loss by transferring crypto between my wallets, and I'm going to claim a loss. That's no, you can't. And no country allows that. But that was on crypto Twitter for what they were going to do. And whether they were going to try to fly under the radar of a government, who knows? But if they use, there's software that allows, and techniques and algorithms that detects that and shows that, no, that doesn't work. Anyway, I'll turn it back to one of you guys for a comment.
No, that is very fascinating, and I want just to address or pick up what you addressed and probably add some additional complexity. Let's say there have been quite a lot of advisors in the past here in, let's say, at least in Germany, who told, okay, we do not know what from a legal perspective cryptocurrencies are, and therefore, because no one really can determine it, it's non-taxable at all. Of course, from an accounting perspective and from a tax perspective, it's quite clear that it's taxable, somehow taxable. And there has been some guidance in respect of, especially in respect of cryptocurrencies. But this is an evolving landscape of digital assets, and it's less digital assets. And therefore, the question is how other digital assets are, or what's the taxation framework for other digital assets, probably which are not, let's say, on the scale or have not the, let's say, scale as the currencies right now, but are representing, let's say, other, let's say, business activities, and there we have no guidance at all, or more or less no guidance at all, how these other digital assets are taxed. And so it is very likely that they will be taxed, or that they are taxable investments. Let's talk about NFTs and not even stable coins, but or other issues. And there's a question for the investors. They will be taxable, or they are taxable potentially in many jurisdictions. What is the tax base? How to establish the tax base? Where I get all the relevant information? And if it's just really, that would be then the ultimate complexity from my perspective. It is just the token or the crypto digital asset as such, or does the digital asset is referencing something else, and therefore, let's say the referenced assets is establishing the tax base for these assets, and there we have no guidance here in Germany at all, and that's let's say really tax uncertainty. Would be interesting. What is, let's say, the status in the US thereof, and probably one of the last, our time is running out. Would DLT or blockchain really solve this up to a certain degree in the future? Yes or no? I doubt, but I'm throwing the questions.
Great question. It's funny because yesterday Ali sent us an article. I don't know if either of you had a chance to look at that, but that was one of the things that was suggested there, is that, from a technology perspective, is there a better way, to do this? But, I think one of the things that I would say is that you're correct in that, back to Roger's point, there's no question that many of the different transactions out here are definitely taxable. It's just that I think the question, at least on the US side in any of these countries, is what kind of tax is it and when is it taxable? I think those are kind of two of the fundamental things that come up. You mentioned the Jarrett case earlier, Roger, and I think that's a great example of, that case was around staking rewards, or proof of stake, or proof of work, which is, so people think staking and they think it's one thing, but actually you dig into staking and it really can be maybe two or even more different things. And so as a result of that, I think the Jarretts wanted, the US government to really give an opinion on, is it really taxed upon time of receipt, or is it taxed when I dispose of the income? And to your point, the US government punted on that one and decided not to give a ruling. But I think that's a great example of, there are many scenarios out there where digital assets are evolving at such a rapid pace that governments do need to kind of hold on giving regulation, because they can give regulation and then very next day it's going to be ineffective just because of a new evolution of the product comes out. We were talking loosely about NFTs yesterday, Robert, and I mentioned that here in the United States, NFTs, forget the federal gain loss conversation. At the state level, NFTs are now, some of them are looked at not as, they're being created as goods and services. So they can unlock goods and services transactions as opposed to being an NFT that represents a collectible or an artwork that you might have heard of. And so, for example, you might purchase a ticket to an NBA basketball game that it's an NFT that unlocks your admission to the game, but you also get to save that NFT as your memorabilia for attending the game later on. And here in the States, in some states, attending a sporting event has an excise tax consequence to the seller of the ticket. And so that definitely was not contemplated in state excise tax laws or sales and use tax laws. And so we've seen the Multi-State Tax Commission, actually, this is over the last year, has raised this issue specifically around NFTs. And we've seen, for example, the state of Washington recently released guidance indicating that they expect sales tax to be collected on some of these transactions. I think it's a bit premature. I think that NFTs are at the we're just seeing that technology evolve and the use cases of how NFTs can be used at a more commercial level. And I just think that, those tax issues are going to continue to grow. So I don't know, that's just a few more unknowns that we need some advice on. But I think back to Roger's point, governments have to wait until they have more information to issue guidance.
I think we're running slowly out of time, even if I think there could be many topics addressed and drilled down in much more in detail. So probably as the last very brief round, just one or two sentences. What is the most fascinating factor at this moment if you regard tax technology and this environment? What stirs you personally, or what is most exciting for you personally?
I think from a blockchain perspective, the blockchain itself doesn't have economic character or economic significance. It's more of a record keeping. But with the appropriate data tools, you can actually give economic significance to the transactions so that the private sector can fulfill their compliance obligations and the government can do the appropriate check as well as the appropriate risk analysis so that they can determine who to leave alone and who to look at to make sure that they've appropriately done their tax compliance. That's what we're doing in this space with regard to tax and technology.
Wendy, your last or your most your thoughts about what is fascinating?
I think that, I thought that was a great statement, Roger, because I think that that's the thing is I think that when you think about how our government could use blockchain, that to me is exciting because I think that technology in many use cases outside of tax administration is exciting. But I think the problem with it is, and I was, the Department of Homeland Security here talks about this on the Department of Homeland Security here in the United States is investigating the use of blockchain for a variety of use cases. But they, one of the things that they're really putting their efforts into is exactly what you just talked about, Roger, which is, security. There is information security, PII that has to be protected. There is protocols just from having multiple users within a particular instance of the blockchain. And so I think for it to be usable within government, it does need to have some of those other features around it. And so that to me is the exciting part, is how we can use the fundamental record keeping aspect of it that is so transformational in so many industries, how we can use that, but in the private sector in a secure way.
Yes. Let's say from my perspective, in the regulatory sphere, let's say there are sandboxes in the tax environment. Let's say everyone or the governments are not interested in any sandboxes, so they have to, let's say, work on the living, developing animal. To put it this way, would be a pure German phrase. So I think that is really developing topic and keeping us interested over the next time. And, to the audience, thank you very much for your interest. Wendy, thank you very much, and Roger, thank you very much. It was a really thrilling exercise and thank you very much. Bye bye.